Hello everyone, and in this video we are going to analyze June 2021 CPI numbers and Federal Reserve Chair Powell response. Let's jump right in. In first step, let's look at the Federal Reserve goals and progress towards those goals. According to Google, Congress has given the Fed two co-equal goals for monetary policy. First, maximum employment, and second, stable prices, meaning low, stable inflation. In pursuing those goals, Federal Reserve uses notorious Phillips curve. What Phillips curve is? Phillips curve, you can see it on the screen, reflects inflation rate and unemployment rate. And it basically says the more inflation you have in the system, the less is your unemployment, and other way around. This Phillips curve was debunked during 1980s when inflation and unemployment went up simultaneously. This time was called stagflation. Despite this fact, Federal Reserve still sticks with its numbers for difference between the inflation and unemployment as a reliable model they use in their daily work. Current Federal Reserve long-term goal for unemployment is 3.5%. Why they came up with this number? Because before COVID, that's the number they reached and they want to take it as a goal for the next time period. If you now look at the chart here, you see that unemployment was volatile for the past decade, and every time unemployment would go close to this target of 3.5%, something would happen. In 1970s, 80s, it was stagflation. United States reached a goal of almost 3.5% unemployment, and then all the system collapsed and United States went through one of the biggest crises in its history. Another time when unemployment went down significantly was just before 2000 dot-com bubble financial crisis. Then the same happened before 2007 financial crisis. So as you can see, every time they try to reach this goal of low unemployment, something happens, and it might be unrelated, it might be just a coincidence. But if you think about it, how Federal Reserve looks at unemployment, so they basically want to run inflation high. They want to reduce interest rates as low as possible, and currently they are at zero. They want to stimulate the economy through fiscal and monetary stimulus. And every time they run those policies, something happens. Some bubble bursts, and all of a sudden the economy goes back a few steps. I'm not an expert, and there are many other people who are smarter than I am. But something tells me that it's somehow related. Federal Reserve pumping the bubbles and bursting them, and unemployment volatility. Now let's look at the CPI, inflation rate in the United States. So Federal Reserve claims that its goal is 2%, or slightly above 2%, as they say. Current CPI numbers is at 5.4%, which is way above, slightly above 2%. Claimed by Federal Reserve, and it's worse this number has been since the global financial crisis 2008. Very interesting that during congressional hearing meeting on 15th of July 2021, Fed Chair Powell said that he is not worried about inflation as he sees it transitory. He says that multiple factors in the CPI are just high because of the base effect. Base effect means we had a very low CPI in 2020 because of the pandemic, and therefore we go into the higher numbers from the low numbers. The next step, let's analyze June's 2021 CPI. As you can see from the table somewhere on the screen, June CPI numbers, average 12 months is 5.4%, and then let's look into categories behind this overall CPI. What are the main contributors there? The main contributors in this CPI are energy, commodities, last food and energy, used cars and trucks, transportation services, and I would also like to look into the food and shelter. So first, consumer price index for all urban consumers, food and beverages. As you can see, this number was growing steadily for the past 50 years, and it had almost never went down. Especially clearly you can see that in 1980s when inflation was a double digit. Despite that, food had never came back to the levels before inflation in 1980s. Just to remind you that the food CPI is not that high of a contributor to overall CPI in June 2021. It's only 2.4%. Food away from home, the same picture. It's never came back. After double-digit inflation in 1980s, prices of food away from home still went up at more or less continuous rate. The energy CPI is much more volatile, and this is 20% of the June 2021 CPI. So here you can say that there is a base effect that in 2020, where the prices of oil went negative, if you compare that to the current level, then of course you see this drastic increase, and then you can actually trust into words of Chair Powell that it's actually base effect. The question is, of course, how high further those energy prices will go, and the main contributor there will be, of course, oil and gas. And as there's no person in the world who can accurately see the future and predict a price of oil, we will not delve into this any deeper. Commodities less food and energy make a very interesting picture. As you can see, after double digits inflation 1980s, prices for commodities went steadily up. And if you look at year 2000, you can see that they actually went down a little bit. And it's highly correlated with productivity. That production of commodities became much more efficient and less costly as a consequence. And the second, that international trade and huge amounts of imports. That's why US running currently this huge deficit, because they import much more stuff than they produce and sell and export. That actually reduced the commodities price, and they actually went down for some time. As you can see, of course, in 2021 the prices went parabolic, and there's no guarantee that they will come down unless there is a huge productivity burst, or we find next China who can produce goods and services significantly cheaper than you can produce them anywhere around the world, and you can import this cheap stuff into your country. Now, used cars and trucks, again, historically 1980s as a baseline, you can see that prices never came back to the levels of 1980s, but you can see after year 2000 prices actually went down, and it's again to the topic of productivity and import. Of course, in 2021 prices went parabolic up, and there are no clear indication. I'm not using forecasts and indexes for the future because I think no one can clearly predict the future. That's why we only analyze in the past, and from this chart you cannot predict what will happen in the next years. But most likely scenario, if prices will go down, they will never reach the levels before the pandemic. Chart for shelter, and it's only 2.6% in the June 2021 CPI numbers, but I want to look at this anyways. As you can see, there were no price drop during pandemic, and shelter prices steadily go up. If it continues like that in the same rate, it will be steady contributor to CPI above 2%, as Federal Reserve expresses. Last but not least, transportation services. As we all know, in pandemic time, no one was traveling, everything was closed, so it's completely plausible what Chair Powell says, that it's a base effect from the previous year, 2020, that we experiencing now, just prices adjusting and going to the levels pre-pandemic. What will happen to the future, no one knows. And it's also highly correlated with energy, because price of oil will influence the travel. So now let's go to the third point, my thoughts on all this data we received in June 2021 CPI numbers versus what Chair Powell says that it's transitory. First, let's look again into a chart for Federal Reserve balance sheet. As you can see, in 2020 it went parabolic, and Federal Reserve continues to buy bonds and treasuries, if I remember correctly, 120 billion a month. M2 money supply, very interesting correlation between the Federal Reserve balance sheet and M2 money supply. Federal Reserve created reserves, bank reserves, theoretically should not go into the system. Reserves stimulate the economy through allowing banks to give more loans to the public, but Federal Reserve units, bank reserves, are not legal tender. You cannot use them as money in the system. Therefore, the correlation is very interesting, and it might be just an accident, or it might be something going on behind there, what most of the people don't know. We, of course, should factor in high fiscal stimulus, and most of this fiscal stimulus is covered by money printing from Federal Reserve, as US government does not collect enough money in taxes in order to pay for all those trillions of US dollars programs proposed by the government. Another interesting chart, total public debt. Everyone knows US is one of the highest debtor nations in the world, and in 2020 that went even higher, much higher from the previous levels. What does it mean? It means Federal Reserve cannot raise interest rate. If they raise interest rates, country cannot pay the debt, or they will be paying 20, 50, 80% of their tax revenue as an interest on debt. It's an impossible task to pay off such a huge amount of debt, and therefore Federal Reserve must maintain interest rates near zero level. So we look at the figures today, the actual yields represented by Fed funds rate minus consumer price index are negative. If you put your money in US dollars or treasuries and bonds, which is a representation of US dollars, with the current rate, you will lose your money at the minus 5% rate. And of course, the big question here, will consumer price index remain at such a high level? And if so, will Federal Reserve do anything about it? Can they do anything about it? Because Federal Reserve claims that they have tools, they can increase interest rates, they can taper. Taper does not mean that they suck liquidity out of the system. It means that they will reduce their 120 billion purchase program per month to a lower number. Therefore, many people claim that Federal Reserve actually stuck. They cannot raise interest rates, they cannot taper, because then economic system will collapse. And if you look at the research of such smart economists like Dave Rosenberg, he actually says that all the positive GDP numbers in this year we see, it is a consequence of fiscal and monetary stimulus. If Fed actually tapers and raises interest rates, US economy most likely will collapse. Now let's look a little bit into the history. The interesting fact that in 1980s, the Federal Reserve chair, Arthur Burns, was claiming that CPI increases were transitory. I will post the link to this article below. So if I read it like business cycles, he believed price trends were heavily influenced by idiosyncratic or exogenous factors, noise that had nothing to do with monetary policy. In 1980s, prices of oil went parabolic, they went way up, and Federal Chair Burns decided to take this out of CPI. Then the same happened for food, and again he concluded that this number should be taken out. And then it started to happen to multiple other commodities and products and services, and at the end only 35% of CPI left, and even those 35% increased by double digit. As Mark Twain says, history does not repeat itself, but it rhymes. So it's quite interesting to observe today that Federal Chair Powell also claims those abnormalities in price index to be transitory. Because if he's wrong, it took Federal Reserve to take interest rates up to 20%, which today's US government cannot do. It means if inflation in US is actually persistent and self-enforcing, Federal Reserve cannot fight it. Therefore, for every investor, and I know that many investors right now are asking themselves this question, is inflation transitory? Is it cyclical? Or is it secular? At this point of time, it's one of the most important questions for investors in order to preserve their wealth, let alone gain it. I hope you like this video. Let me know what you think in comments, and I see you in the next one. Bye bye.